A couple of things. Number one, I would increase my allocation to cash for a couple of reasons.
Really?
Yeah.
I did not expect you to say that, Jim.
Well,
I had my money on gold, quite literally.
let me. Okay, I'll stick with cash, but let me kind of put that in a context. The most powerful investment tool we have is diversification. Now, that sounds like an obvious statement. Oh, yeah, everybody knows that. They teach you in the first week of risk management. Diversification is the way to go. Well, it is the way to go. The problem is people don't understand what diversification means. So I run into people all the time. They say, well, I'm completely diversified. I own 50 different stocks in 10 different sectors, semiconductors, consumer non-durables, minerals, et cetera. And I say, you're not diversified. You may own 50 stocks in 10 sectors, but you have one asset class, stocks, which are subject to conditional correlation. They, in calm markets, they're idiosyncratic, but in panics, they all go down together, or in bubbles, they all go up together. So you're not diversified. So what is diversification? Diversification is having slices of asset classes that are minimally correlated. It's probably not zero, but as close to zero as you can get. So what would that be? You'd have a slice of gold, but I recommend 10%. I have some strong views on gold, and I've written a lot about it, but people are surprised to hear me say 10%. Like, oh, Jim, why isn't it 50% or 100% if you believe all this? Well, I do believe it. I wouldn't say it if I didn't, but you don't want to be 100% in anything. You don't want to be 50% in anything. 10% is fine. If I'm wrong, you won't get hurt. And if I'm right, you're going to make so much money that it'll actually kind of be the insurance on the rest of your portfolio. But that leaves 90%. So I would have a large slug in cash, maybe 30%. And people say, well, wait a second. Banks pay me 25 basis points. Stock market's going up. Why would I want to be in cash? That's horrible. A couple of things. Number one, the stock market might not always go up. But number two, cash is the opposite of leverage. So leverage increases the volatility of the rest of the portfolio. You'll get much bigger returns, but you'll have much bigger losses. If you have a slice of cash and you've got a volatile asset over here, which are stocks, and another volatile asset over here, gold's fairly volatile for reasons we don't have to get into right now. If you got that volatility and you have cash, it will reduce the overall volatility so you can sleep better at night. Cash is a great asset in deflation. We've spent a lot of this interview talking about inflation, which is here, and you got to deal with that. But don't rule out deflation. If we go into a recession because the Fed over tightens, or the thing about the inflation, just a quick aside, it comes in two flavors. There's cost push and demand pull. Demand pull is when individuals are worried about inflation and they start accelerating purchases, like, hey, I better go buy that washing machine right now because the price is going up, or better go buy that house right now because the price is going up. That's demand pull. Cost push comes from the supply side, not the demand side. And that's what we're seeing because of what we talked about, supply chain, energy cost. The Fed can't drill for oil. Raising interest rates doesn't get you more oil or natural gas. So the Fed can't do anything about it except kill the economy. Yeah, and that'll cool it off. But when you pay, I put gas in my car. I don't just read about this stuff. It used to be $45. Now it's about $75. Well, when multiply that by 200 million cars across America, what happens is it reduces your discretionary income. If you're paying another $30 at the pump twice a week, then you're not going to go out to dinner Friday night. You're not going to, take a vacation, whatever it may be. So that depresses all those other areas. So there is this recursive function. So don't rule out deflation down the road, not right away, but maybe next year. So cash, but here's the biggest value of cash. It gives you optionality, and people don't understand this. What if I said to you, hey, I'll sell you a call option, an at the market call option on every asset class in the world? You go, gee, that sounds kind of valuable. Well, that's what cash is. When things are crashing, you're the one who can go shopping, and nobody's better at this than Warren Buffett. He's got his cash level at Berkshire Hathaway is at an all-time high. So there's a place for that. You can have some stocks, but I would look at the energy sector. I mean, this, I've done a lot of work in climate change. I mean, climate change is real. Okay, let's start there. I used to live for 10 years on a beautiful body of water, Long Island Sound. You can fish and swim and sail and do all kinds of things, great lobsters. But it's the shape it is because it used to be a glacier. In the last ice age, it was the lowest latitude of glaciation in the northern hemisphere. That's why it has a rocky coast. So there's climate change. It was a glacier. Now now you can go sailing. So it's real, but it's slow. And all the stuff about the existential crisis in 10 years, they've had a rolling 10-year doomsday for 40 years. So that lacks credibility. There is no climate crisis. There is no existential crisis. So you have to discount the climate alarmists. And they want, wind turbines and solar and maybe a couple other so-called renewable sources. I actually built and I own the largest non-commercial solar module field in New England. And I run my house off it. It produces about 7.5 kilowatt hours. So I know a little bit about it. And what I know is it doesn't work at night. It doesn't work. It doesn't work in snow. It doesn't work in rain. It doesn't work in really cloudy days. By the way, you don't run your house off of solar modules. You run your house off of batteries.
Yeah.
And then the modules charge the battery. So you watch the battery level. That's how you manage it. Don't run the dishwasher on a cloudy day. But so it works fine. But if you think you can run cities with that, forget it. I mean, I had to clear 3 acres to put up my towers. People say, "Why'd you clear 3 acres? They don't take up that much room." I said, "Well, have you ever heard of trees? There's no trees in the desert, but they have them where I live, and you don't want a tree falling on your tower." So it's just not practical at that scale. And even if you thought it was, and it isn't, that's very clear. But here comes wind turbines and solar. And I'm not against it. Like you say, I own one, but they're not scalable. They're intermittent. And they don't give you the base power, baseline power you need to run a modern power grid. Meanwhile, here's global demand. Okay, so the gap's getting bigger. It's not getting smaller. Renewables, whatever the pros and cons, are not closing the gap. The gap's getting bigger. There is no substitute for oil and natural gas and uranium. You got to put uranium in the mix, and hydro. If you live in Quebec, that's great. A lot of hydro, but not so much in the desert. And I've spoken to, without mentioning names, I would say you can go no higher in terms of who knows. Let's just say board members of one of the 5 biggest oil companies in the world, who said, yeah, as he said, we talk about that, but we can't say it publicly because we'll be, dragged, chained and dragged through the streets. But those are just the facts. So therefore, if you have an oil sector that's been bashed by the climate alarmists, but you can't do without it, which is true, buy some oil companies. When they're so there's your stock portfolio, private equity, venture, real estate, not commercial but residential, yes. And farmland, that's one of the hottest asset categories, and gold. So that's diversification, and that's the kind of portfolio you want. You kind of season to taste.
And no crypto, Jim.
Well, look, I enjoy playing roulette, and I have my system. I'm still, like Marcel Duchamp, I'm still working on it. But the reason I prefer roulette to crypto is because you get a free drink when you're in the casino. but that's how I think about crypto. I'm not a crypto basher. When I was a teenager, there was a popular song called "Shout, Shout, Knock Yourself Out," and it was nice dance. But if you want some crypto, knock yourself out. Go get it. I'm not bashing it. I'm not against. I don't know. I don't own any. I don't plan to. I don't recommend it. But I'm not I'm not lying down in front of a truck trying to stop the crypto move. It's here. I've actually studied it more than all but a few people, and I've arrived at ways of understanding it that are probably nobody in the world really gets, although I've started to write and talk about it. So I think I have a very good handle on it technologically, mathematically, and really in terms of communications theory. But it's not. Well, let me put it this way. I'll say crypto is not money, but what crypto is doing is erasing the definition of money. So maybe the dollar is not money either, and that's really the point. It's not the case that Bitcoin is going to replace dollar as a global reserve currency. That's not going to happen. But Bitcoin might contribute to a concept of moneyness, not money, but moneyness, which is it's kind of like money, but maybe the dollar is getting there also, and we're losing the threat. We don't know. My thesis would be we don't know what money is anymore, but we don't know that we don't know. It's like some metaphors are better than others, but the saying we don't know who discovered water, but we're sure it was not a fish, because the fish is in the water. You got to take the fish out of the water, and it's like, hey, where's the water? But when you're immersed in something, you actually don't know what it is. And we're immersed in electronic orb, if you will, and it's erased a lot of concepts, but we don't know it. And so I think we're seeing the end of money.
Very interesting, Jim. Well, I'm sure we'll get an opportunity to talk to you about that next time, because I think it deserves a little bit more than a couple of minutes. But as always, thank you so much for coming back on the show. We're going to do a couple of very special questions from our audience for you, from our local supporters. Before we do that, we, as always, have our last question, which is, what is the one thing we're not talking about as a society that you think we should be?
Probably debt. And again, it kind of goes back to, we're losing the concept of money. Well, are we losing the concept of debt? And I've studied, I've read and researched and done my own work on the history of debt. And of course, we're seeing the rise of modern monetary theory. And, we go around the U.S. Congress, I dare say, out of 535 members, you can't find more than 5 or 6 who could tell you what modern monetary theory is. But that doesn't matter because they've all adopted it. Our fiscal policy in the United States is modern monetary theory, whether the members know it or not. And the theory is, part of the theory is that the debt can be as high as you want. Debt to GDP ratios don't matter. As long as the debt's in a currency that you print, what's the big deal? You can always just print it and pay the debt. There are unmet needs in society. And to the extent that they require money, just print the money. And the leading advocate, Stephanie Kelton, is a professor at State University of New York, said we don't even need a bond market. And this, again, this is from her book, so I'm not putting words in her mouth. These are her words. She said the U.S. Treasury market only exists as a favor to investors. We're giving you a place to put your money if you want to, but we don't actually need it. We could actually just give wire instructions from Lockheed and Boeing and Medicare to the Fed. They could just send the money right to Lockheed to pay for stuff. Why do we have to issue bonds and take the money and get the Fed to buy the bonds and then use the money to pay military contractors? Just send them the money. What's the big deal? So that is what's going on. But there was a reason we used to care about debt, because it was sort of, there's something behind it that is being taken for granted, which is creditworthiness. Yeah, we don't have to pay off the national debt. We don't, but we have to roll it over. That's the thing. And is your continued access to the market, if you take that for granted, you're probably eroding your credit standing. And there was a reason we used to lower the debt. This goes back to David Hume. Among others, and it was in case you had to issue debt to fight a war. In other words, and the history of U.S. debt is it's not a straight line from 0 to 30 trillion. It goes like this. It goes up and down. Adjusted for inflation, that's even more extreme. But the point being, you would pay down your debt in times of peace so that you could borrow money in times of war. It was that simple. And the only exception to that was the Great Depression. And you can kind of think of the Great Depression as an economic war. But that was abandoned around 2000, but really starting with Obama and Trump. And now we've lost the concept. So the U.S. is ill prepared for a day when credit may be an issue and we may actually need to borrow the money.